Hi, I'm Clay Hostetter. I am the tax planning manager here at Rhame Gorrell Wealth Management. I'm also a CPA, CFP, and SEMA professional. And today we're going to be talking about how you can supercharge your retirement savings in a very tax-efficient manner through the use of the Mega Backdoor Roth conversion. Now, this is a very long name, and we're going to break that down for you today in this video to hopefully give you better understanding as to what it is and how it works. The premise of the Backdoor Roth conversion strategy is to move funds from a taxable account to a Roth account. And it's the same with the Mega Backdoor Roth conversion strategy. It's just taking place in your 401k. In your 401k, there is an after-tax account that we will utilize to put funds into and then convert those into the Roth account within your 401k, therefore letting those funds grow and be distributed tax-free. Within your 401k, there are three accounts or buckets that you can put money into. The first is the pre-tax account. Every dollar you put into this account or bucket will be tax deductible in the year that you contribute it, but all of the growth and the distributions from that account will be taxable to you at your highest marginal tax rate. The second bucket or account is the Roth account. Here, every dollar you put in the year that you put that money into that account will be taxable to you on your tax return. But the growth and the distribution of those funds in retirement is completely tax-free to you. The third account is sort of the worst of both worlds when it comes to taxes. It's the after-tax account. When you put money into the after-tax account, it's going to show up on your tax return that year as taxable income, and all of the growth that happens in that account is taxable to you when the money is withdrawn. This is why the Mega Backdoor Roth conversion strategy looks to, once you put money into this after-tax account, roll it into the Roth account, essentially allowing you to put more money into your Roth account every year for that tax-free growth and distribution. To break this down even more, we're going to walk through an example. Let's say there's a man named Darren who is an oil and gas professional here in the Houston area who makes $250,000 a year in his salary. Now, say Darren is putting into his pre-tax or his Roth account, he's putting the IRS maximum for 2023 of $22,500. This is the maximum he's allowed to contribute from his payroll. Then, say that Darren also gets a 7% match from his employer. That's $17,500 that his employer will be putting into his 401k plan for him. So Darren thinks he's maxing out his retirement savings with $40,000 going into his pre-tax or Roth accounts. But what Darren might not know is that the IRS limit of how much he can put into all three of these buckets for the year is $66,000. So Darren's actually leaving $26,000 of retirement savings on the table. Now, Darren, in the Mega Backdoor Roth conversion strategy, will take that $26,000 he can put into the plan. He will put it into that after-tax account, and before it has time to grow and have taxable growth, he will roll it into the Roth bucket where he will be able to collect that tax-free growth and distribution of his contributions and growth. Now, say Darren does this for about 6 years and is able to accumulate contributions of $156,000 in his Roth account because every year he's making these Mega Backdoor Roth conversions. Then say that the funds grow to $200,000. So there's $44,000 worth of growth in there. Every single dollar he pulls out will be tax-free to Darren. This is where we'd like to emphasize a major pitfall of not doing the Mega Backdoor Roth conversions, which is the Pro-Rata rule. Say that Darren, instead of rolling these funds in the after-tax account to the Roth account, lets them sit there because he doesn't know that he can roll it into the Roth account every year, and he lets that account grow. Again, say that Darren lets his contribution basis grow to $156,000 over 6 years, and it grows to an account value of $200,000. Well, the Pro-Rata rule states that a proportional amount of that account based off of the growth will be taxable to him when it's distributed. Pretty much, that's fancy terms for saying since there's $44,000 of growth on the $200,000 account, 22% of that account, or 22 cents on every dollar that's pulled out of that account, either through distributions or rolling it over to a Roth later, will be taxable to Darren. It's included in his tax return as taxable income and will be taxable to Darren at his highest marginal tax bracket. Now, the pro-rata rule isn't the only pitfall that is in the Mega Backdoor Roth conversion strategy. There are many others. And here at Rhame Gorrell Wealth Management, we look to be experts in your specific plan for your specific company in order to help you navigate around these pitfalls and to maximize your retirement savings in your company's specific plan in order to reach your retirement goals. If you'd like to meet with one of our numerous CPA, CFP, CIMA, CFA professionals for a complimentary consultation, please reach out to us using our phone number, our email address, or visiting our website. If you'd like to see more articles on topics such as the Mega Backdoor Roth conversions, retirement savings, or other tax topics, please visit our website to read more about those.